Corporate Finance Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel related to a LIBOR loan effective interest rate calculations. In other words, we're going to have a loan which has a different set of terms in terms of having Corporate Finance Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel related to LIBOR loan effective interest rate calculation. In other words, we're going to have a loan that's going to be set up a little bit different than what we would standardly think in terms of stating the standard interest rate and then calculate the effective interest rate on it so we can think about it in more of a standard way. Get ready, it's time to take your chance with corporate finance. Here we are in Excel. We have our information on the left-hand side. We're going to put that into our worksheet into the blue area on the right-hand side. This is going to be our scenario. We have the borrowing, so we're considering borrowing at the $10,000. We're going to be borrowing for exactly 1 year, so we'll think about borrowing $10,000 for 1 year. Then we have our terms down below. We have the prime rate at the 9%, and then we have the LIBOR rate, which is typically going to be stated in a little bit different of a format. And then we want to be thinking about, well, how can we compare that format to like a standard format so that we can then make comparisons. So the LIBOR rate is going to be 1% less than the prime rate. So the prime rate is 9%. LIBOR is going to be 1% less. So we're going to say 8%. But there's also going to be a transaction fee of $105. So you can see now we have this added cost that isn't normally in the percentage calculation of the interest. And we got to say, well, what if I was to compare that then to 9%? What if I can get a loan for like just 9% at the $10,000 and have the normal process, which would be that we're borrowing money today, getting $10,000 today, that we're going to pay back in exactly 1 year, giving back the $10,000 original money we borrowed plus 9% interest on it at that point in time versus this format where we're really going to have 8% that we're talking about here. That's pretty straightforward. But now we've got this fee that we have to take into consideration. How can we basically be using a comparison when we have this kind of cost of borrowing not reflected in terms of the interest rate, but in terms of a fee? Well, in general, we can kind of think of that fee as being similar to basically interest because it's a fee for us borrowing the money, which is in essence pretty much like the same thing as what interest is. So we can use the same calculation and just kind of add that fee into what the interest would be. So here's our two calculations. They're the same thing, but remember what we have is our original formula, I equals P times R times T, which is the loan or the principal times the rate times time, which is a fraction of a year, which we can then calculate as R equals the interest divided by the P times T when we're looking for the rate. So this is what we're going to be using here. And we could basically rework that to take this fraction out of the numerator and take the inverse of it and look at it in this format. Interest divided by principal times the days in a year, which we're going to say 360, nice even 30-day months, 30 days times 12, divided by the days in the loan. In this case, that being the same because it's going to be a 1-year loan. So let's use this calculation first, and then we'll do it the same kind of thing in the terms of this calculation and focus in on that kind of new component, which is going to be the cost being reflected not in interest, but in a fee. So let's do that up top. I'm going to say, all right, let's do this one, interest divided by principal. Now this is where the difference will be because what we're going to do is say interest and fee because really the fee is kind of like interest, right? Interest is kind of like the rent of us borrowing the money, and we're going to have to pay back the rent plus this fee, which is pretty much the same thing. So that's going to be our difference. Here's the new thing here. So the interest, which we'll simply call interest, is going to be the 10,000 times 9 minus the 1, or 8%. So we can write that this way. We can say it's going to be the 10,000 and then times. I'm going to put brackets around this and say I'm going to pick up the 9 minus the 1, which will give us 8%, close up the brackets. 10,000 times 8%, 10,000 times 0.08, giving us $800. Then we're going to add the fee to that. I'm going to say, all right, now the fee is going to be the 105 that we're going to have to tack onto that as basically the cost of us borrowing this money. I'm going to underline this, Home tab, font group, and underline. That's going to give us the interest and fee that we'll add together. I'm going to put that in the middle column now. Adding this together, this equals the sum of the 8 and the 105. So that's the new thing. I'll make that yellow. That's what we got to include there. And then we're going to be picking up the principal in the numerator of this first component. Let's go ahead and indent these while I'm here. I'll select these three: Home tab, Alignment, increase the indenting. Selecting this one, Home tab, Alignment, increase the indenting. And then we're gonna compare that to the principal, which is the amount of the loan, and that's simply going to be the 10,000. So we have the 10,000. Let's put an underline here. We're going to go Home tab, Font group, and underline. That's going to give us a subtotal, which we're going to say this is the outer column, our first part of the calculation here, which is going to be equal to the 905 divided by the 10,000. Let's add some decimals here because this is often a small number. Home tab, number, adding a few decimals. So there we have that. And then I'll indent here, Home tab, Alignment, increase the indenting. And then I'm going to go to the second component, days in a year divided by the days loan as outstanding, inverse of the basically time ratio. And that's going to be the days in a year. I'm going to put it into this middle column. This is going to be equal to the 12 months times, we're going to assume 30-day months for a nice even 360-day year instead of 365, which is a little more accurate. Days loan outstanding, and there's reasons why we would want an even year versus 365, so you can use either one. But the days the loan is outstanding is 1 year, so 12 times 30, same thing. And we're going to underline this, Home tab, Font group, and underline. That's going to give us our subtotal. Putting that in the outer column, which will just be 1 because it's going to be 360 days divided by 360 days, or 1. And I'll indent this. Home tab, Alignment, increase the indenting. That's going to give us our effective interest rate. And I'm going to say this will be equal to this number times 1, the outer portion. Let's percentify that by going to the Home tab, numbers, percentifying it, add a couple decimals. Let's put an underline under the 1, Home tab, Font group, underline. So if I try to compare this out, I'm going to say, well, that really, if I count the fees in my calculation, and I try to compare the same thing to the same thing, apples to apples, rather than an apple to like an orange or something, then, or an elephant, an apple to an elephant, that would be really different. Well, anyway, we're going to have the 9.05 compared to the 9%. If we can get the 9% loan, it looks to be a better, loan given the effective interest rate. Now, if I was to calculate this, and we were to say, all right, well, what if I was to calculate the interest, plugging this back in and calculate the interest, P times R times T. So that would be, let's do that. We'd say, all right, well, the principal would be 10,000 times the rate, which we're saying 9.05, times the time, which is simply 1, or 360 over 360, which is going to be the 905. And the 905 is what we would think of as interest, but notice it now includes the interest and the fee that we're talking about, the 905 up top. Now we could do the same calculation down here. We could say, let's do it just using this formula instead. So we'll use this formula. So I'm going to say interest on top, but once again, I got to change that interest to interest and fees. So I'm not going to do the sub calculation again. I'll just say this is interest and fees. I'll put that on the outer side. This is going to be equal to we can recalculate it. It would be 10,000 times, I'm going to say, the 9% minus the 1%, which would be 8%, putting the brackets around that, plus we have to pay for the 105 that we're going to have the fee added to it. So that's going to be the 905, same calculation we had up top. Once again, this is the new thing. I'll make it yellow to show that it is the new thing. And then we have the principal. So the principal, I'm just going to say equals the principal up top is going to be the 10,000. So that'll be the 10,000 here. And then the percentage of a year, we're going to do that same kind of subtotal calculation. So percent of a year is going to be the days of loan. I'm going to put this in the inner column. That's going to be the days of the loan are going to be 1 year. So I'll say 12 times 30, and then the days in year are going to be 12 times 30. So something happened here. Equals 12 times 30, And this equals 12 times 30. All right, and then, so it's going to be 1. So then the percent of a year is simply 1, which would be the 360 over the 360. And so now we have the principal and the time, principal time, underline here, and we'll put that, and that'll be the subtotal. Put in the outer column. This is going to be the principal 10,000 times time. We'll underline that. Home tab, font group, and underline. This once again giving us the effective interest rate, which is going to be that 905 divided by the 10,000. If we percentify that, home tab, numbers, percentify, add a few decimals, once again at the 905, which is greater than the 9% rate if we could get that. So we could double check this using our interest calculation. That would be this formula. So that would be equal to the principal, which is going to be the 10,000 times the rate that we just calculated here, 9.05 about, times the fraction of a year or the time, which is just 1. And that's going to give us, once again, the 905, which includes both the interest and the added fee that we would have. Home tab number, I'm going to make this blue and put a little box around it so it looks like our normal kind of standard. So once again, allowing us, this calculation allowing us to basically compare loans that might have fees or a different loan structure to kind of a standard loan structure so we can make effective decisions on them.